Today's topic, Chapter 3, is on financial analysis. Now, this chapter is actually related to Chapter 2, and basically we'll learn how to interpret financial statements. In Chapter 2, we learned how to prepare a complete set of financial statements, and in today's topic, we will learn how to interpret the figures. So financial analysis is also called ratio analysis. Now, some of you may have done this before in trimester 1 when you did your assignment for financial accounting, right? The question asked you to evaluate the performance and evaluate the financial position of the company. So some of you had already used this before, ratio analysis. Okay, so it actually means interpreting the financial statements. So, okay, ratio analysis. So financial ratios, which are what we are going to learn today, it involves a lot of calculation. Financial ratios are relationships determined from a firm's financial information. Now, we have learned last week that there are 4 types of financial statements. We have SCI, Statement of Comprehensive Income. So this statement tells us what are the revenues and expenses of a firm. And the Statement of Financial Position, SFP. SFP tells us the financial position of the company. We have a list of assets, your fixed assets, current assets, and then we have shareholders' equity. We have the long-term liabilities and also the current liabilities. And we have this third statement, Statement of Changes in Equity, which basically talks about the retained earnings, previous year retained earnings, and current year, how much you have retained, how much dividends you have paid out, and what is your retained earnings carried down. And lastly, we also learned this Statement of Cash Flows, which has got 3 different types of activities. We have operating, we have investing, and also financing activities. So from these 4 types of financial statements that we have learned last week, today we will look at how we use ratio analysis to interpret all those figures that we have inside by forming relationships between 2 or more figures. Okay, so in these statements, we might have seen figures like net profit. We can see their sales, assets, liabilities, and so on. So from ratio analysis, okay, we use ratios to interpret the raw numbers. Now, from the financial statements, let's say you see net profit, which is a particular figure. We may not be able to tell how the company is performing just by looking at the raw number. Like, say for example, if let's say we are looking at a company and we know that their net profit is 1,000 ringgit. Okay, so if I ask all of you, do you think that 1,000 ringgit net profit is considered good profit or not? Some of you may say yes, some of you may say no. But from this figure alone, we cannot actually tell how well the firm is performing, because we do not know what is the size of the company, right? Smaller size, if you have 1,000 net profit, it may be a very good profit for them. But if it's a very large company, then this profit may be too little. Okay, so by looking at this raw number, net profit of 1,000, this number itself does not give us any information about how the company is performing. Okay, so how do we actually form relationships? Now, we learn this ratio analysis. We have to form relationships so that we can get a clearer picture of how well the company is performing. So, say for example, if we know that the net profit is 1,000, and with another piece of information, let's say we know that the sales is 10 million. Now, if the sales is 10 million ringgit and their net profit is only 1,000, then if you use net profit divided by sales, okay, this is one of the ratios that you will learn later. their net profit margin is only 0.01%. In other words, it means that if I have made sales of 10 million ringgit, only 0.01% of this 10 million ringgit is my net profit. So in other words, this company is earning very, very little profits. Okay, so by looking at this raw number itself, why do we actually need to learn ratio analysis? If we do not form a relationship between net profit and sales, there is no way we can know whether this 1,000 ringgit is a good profit or not. Okay, so after we have formed the relationship, you see we use net profit divided by sales, we get that the net profit margin is 0.01%. So now we have a clearer picture of what is the profitability of the firm. Before this, you do not know by just looking at this 1,000 ringgit. So if we look at another firm, let's say firm B is also earning 1,000 ringgit net profit, but we know that the sales for firm B is actually 5,000 ringgit. So if we calculate the net profit margin, we use this 1,000 ringgit divided by 5,000 ringgit. We find that their net profit margin is 20%. So for a small firm, a 1,000 ringgit net profit can be a very good profit. But for larger firms, this may be too little. Okay, so when we are evaluating the performance of a company, we do not just refer to all these statements. Okay, we can see their net profit. Okay, let's say from this SCI, we see that the net profit is 1,000, but it doesn't give us much information. Okay, so that's the reason why we need ratio analysis to help us to analyze a company. Okay, so here it says that financial managers, they use ratios to interpret the raw numbers on financial statements. Okay, that's the reason why in chapter 2 we first teach you how to come up with all these statements, and today's lecture we will be looking at how to interpret those numbers. Okay, so who uses financial ratios? The first one will be management. Management uses financial ratios for planning and evaluating. Okay, I believe you still remember that when you learn management, we have the 4 management functions, the POLC. Okay, P stands for planning. Okay, so planning means setting goals and deciding how to achieve them, right? So the managers in a firm, they may need to set financial goals for the company. Okay, by setting financial goals like what is your targeted sales, what is your targeted profits. So by using financial ratios, you can look at your results in the past, how well have you performed in the past, then you can actually set goals for the current year. Okay, and then you decide how you actually achieve those targets, how you actually achieve those financial goals. Okay, and to evaluate, remember the 4 management functions again, POLC. C stands for controlling. So under the controlling function, we have to evaluate performance and take corrective actions. So how do we evaluate the performance of a firm? We refer to the goals that we have set in the planning stage. Okay, what are the goals that we have set, and we compare it with the actual results. So to evaluate, okay, so financial ratios allows managers to do planning and evaluation, and if they are not able to hit their target, they are not able to achieve their financial goals, then they will have to try and find out what has happened and how do they actually take corrective actions to correct the situation. Okay, and then they will continue to set financial goals for the following year. Right, so secondly, we have credit managers. Credit managers to estimate the riskiness of potential borrowers. Now, if a firm needs to, let's say they need to borrow money from a bank, the bank doesn't just easily allow you to borrow, right? The bank may have to evaluate your company, evaluate the riskiness of the potential borrowers. They have to look at your ability to pay back. right? If they find that, oh, this company is not having a very clean record, or the company is not having a very strong ability to pay back, then they may decide not to lend money to the company. Okay, so by evaluating their financial statements, they can use financial ratios to estimate the riskiness, okay, whether they think that their potential borrowers can pay back or not. Okay, then thirdly, we have investors to evaluate corporate securities. Now, in chapter 1, we say that investors are those with savings surplus. Okay, they have excess savings, and firms, they are those that have savings deficit. They need money. They need investors to invest their money so that they can use their money as capital to run the business. So if all of you are investors, I believe you will not just simply dump your money into any firms, right? So investors, they may have to first evaluate how the firms are doing by going through their financial statements. So as I mentioned just now, by going through the financial statements, if you look at the raw numbers itself, it may not be enough. Okay, so they may have to use financial ratios to evaluate their performance, to evaluate their financial position and their future prospects. Okay, once they think that, oh, I'm happy, I'm satisfied with the performance of this firm, then I invest my money in the firm. I buy the shares of the firm. Okay, and lastly, we have managers to identify and to assess potential merger candidates. So if any firm wishes to merge with another firm, before they choose which firm they want to merge with, they will have to first assess the performance of those potential merger candidates. Okay, so basically financial ratios is being used for you to assess or evaluate how well a company is actually doing. Okay, so next we look at this term called benchmarking. Now the word benchmarking actually means to make comparison. Okay, so we say that ratios themselves are not very helpful. They need to be compared to something. So how do we compare ratios? There are two types of comparison. The first one is called time trend analysis. It's used to see how the firm's performance is changing through time. Okay, so usually we will compare through different years, like let's say in 2010, what's the performance, 2011, 2012, 2013. So from, okay, if you have a bar chart, then from the bar chart itself, you can see whether the firm has improved or not in terms of performance. Okay, so we will first calculate ratios and then we compare among different years. So we call that time trend analysis. So this is one type of, one method of benchmarking, of making comparison. Okay, so we don't just look at the ratio itself. Like from the example just now, if the net profit margin is 20%, we may not be able to know whether 20% is good or not, right? So we may have to compare, like, what is your net profit margin in the previous year? What's the net profit margin in current year? Okay, so by comparing through time, we may know what targets to set in the following year. We may know how well we are performing in the current year. Okay, and the next type of benchmarking is called peer group analysis. This is by comparing to similar companies or within industries. Okay, you can see from this picture here, when we are making comparison, the correct way is to compare apples with apples. Okay, so we don't compare apples with oranges. Just like if we want to evaluate the performance of Celcom, we want to know how well Celcom is doing, we compare it with DG because they are in the same industry. Okay, we don't compare Celcom with KFC. They are in different industries, and there is no way. I mean, if you compare how much net profit Celcom is earning and how much net profit KFC is earning, and since they are in different industries, it doesn't give you much useful information. Okay, if you know that Celcom net profit margin is 20%, KFC is 30%, so what? right? It's not a piece of useful information that you can use. Okay, so we'll compare companies within the same industry. It's just like if you want to compare performance of Utah, you compare it with any other private universities, right? You will not compare Utah with Maxis. It doesn't give us much information, right? So yeah, this is the reason why when we do comparison, you either compare through time or you compare to similar companies, right? So making comparison, you can see like okay, this is a cookie shop, right? So 2003, 2004, 2005. So by looking at the graphs, you can actually see how well they have performed, whether their performance have improved or worsened from year to year. Okay, so the different categories of financial ratios, we have 5 different categories. We have liquidity. You have learned this term in chapter 2, right? Liquidity, how easily and or how quickly your assets can be converted into cash without a significant loss in value. Okay, so later on we may have to learn how to calculate ratios related to liquidity. Okay, these are main categories, and in each category we will have ratios, different types of ratios which evaluates different types of performance, like in terms of asset management, how well the company manages its assets; financial leverage management, how well the firm manages the liabilities; and their profitability. The one that we have done just now, net profit margin, is under the category of profitability. And lastly, market based. Right, so in the next video we will look at the category on liquidity.